Hi, good evening, everyone. This is Sahil Kapoor, and welcome to yet another episode of Adding Zeros. Through this series, we intend to get you very, very important concepts, and we want to break it down to very simple ideas so that they are understandable and digestible. For the last 1.5 years, there has been a lot of up and down volatility, news articles, changes in regulations in the banking sector. And banks, as you know, overall, the BFSI sector is the backbone of Indian listed equity space, contributing to nearly a third of market capitalization and profits. And these companies have been, participating in most bull markets in India. If you go back and look at the history of Indian markets, you will see that in most bull markets, banks, lenders, financial companies have performed very, very well. And this post-COVID bull market seems to be an exception where this sector initially did well and then possibly went through a lull phase. It's been a lot of patchy performance. Some companies doing very, very well, others not so much. So we thought this is the right time where we saw in the month of April, Bank Nifty leading and going to a new lifetime high ahead of the index, maybe a few days ahead, and that gives you an idea whether this sector is making a comeback or not. So over the last 12 months or so, many other sectors which have been doing well were big outperformance versus the banks, right? But we've seen recently some pullback for other sectors in terms of relative performance, and banks have started to make a comeback. So today we'll talk about some of the most pressing issues, some of the questions that a lot of people are grappling with when they think about banking. And we'll also talk about the structure on how you can approach and invest in banks. So, what are the various ways where you can approach this sector, whether it is direct equity or any other instrument? And we'll talk about all of them. So, to talk about banks in greater detail today, I have two guests with me. My first guest is Mr. Kumar Saurabh. Saurabh is a SEBI registered research analyst, and he's a director at Technofunds Ventures Private Limited. He's also the founder of Scientific Investing. It's a digital education platform, and we've all seen his very, very deep, insightful content through Scientific Investing. Saurabh has 15 years plus stock market experience in various disciplines of investing and trading styles, including both technical, fundamental, and quants. He's been covered by multiple investing forums and media platforms, including TIA, IIC, IAS, ET Now, and a number of media publications. Professionally, he has worked as a data scientist for a very long period of time as a risk consultant. And he was also selected as one of the top 40 under 40 data scientists in India, uh, back by Analytics India magazine. He's a guest faculty at various prestigious institutions. Welcome to you and looking forward to talk to you on banks today. My second guest today is Mr. Dhaval Gada. Dhaval is a fund manager at DSP Mutual Fund. He's also been an analyst for the BFSI sector for a very long time. He's got a total work experience of more than 13 years. He joined DSP Mutual Fund 5 years ago, 6 years ago now, and he's currently the vice president. Dhaval has also worked at Sundaram AMC, Motilal Edelweiss, and Gridstone. He has a postgraduate diploma from Wellington Institute. Dhaval brings a very, very deep and insightful take on banking with a very strong bottoms-up approach on the whole sector, the whole BFSI sector, and other multiple sectors. So, a warm welcome to you, Dhaval, and welcome to both the guests. So,
Thanks.
let me start by looking at the most pressing problem, which I mentioned in the opening remarks also. So let me, first, Dhaval, first question to you. Uh, Last 4 5 years, if I go back to, let's say, 2018, 19, or maybe the pre-COVID era, banks were the numero uno. If you went to social media or if you met investors, they were only talking about banks. Post things started to improve. Uh, they had shown tremendous profitability, and specifically private sector banks. and some of the names were in everybody's portfolio, including the FIs. So what happened in the last 5 years where when you look at financials, they look good, but performance has not come through. So what has been the challenge for banking over the last 4 5 years?
Yeah. So, Sahil, partly you give a lead of what has happened in the sector for the last 5 years or so. The first point I'll just pick up from your comment, which is over ownership, and just going into the COVID era, we had significant over ownership both from foreign investors as well as domestic institutions in the financial sector, specifically the banks. That was point number one. The point number two was relating to macro shock, which COVID, gave, and that impacted asset quality performance of most of these banks for a short period of time. But that did give a impact on earnings. The third bit is growth really collapsed in the COVID period. For at least 1.5 years, we were struggling on growth. So that again put more pressure on earnings. And finally, the last one, which we are all witnessing right now, is rotation within the banking space, which is happening for the last, I would say, 2 years or so, where public sector banks and select private banks are becoming market favorites, while the big players are getting impacted partly by events and partly by just where we are in the cycle. So all this combination is where the interest levels have gone from, I would say, one extreme to probably another extreme at this point of time.
Sure. Thanks for that. I think I picked up that word over ownership, which highlights how the most fashionable investment can also not deliver. And most often they don't deliver, right? Because prices discount a lot of future, and that's how things pan out. Saurabh, you look at a number of sectors from a tactical point of view. You have highlighted a number of themes which could do well, based on the way that you look at the markets. So, a two-part question to you. One, what is the lens through which you can tactically approach, let's say, sectors? And when you approach banking at this point in time, what are the 2 3 key points that you are looking at tactically or even structurally? How do they look to you?
First thing, when we approach a sector, how do we tactically look at the sector? That is question number one. And second being specific to bank. Now, how somebody approaches to a sector, I think it's something which depends on his own investing style. And in different market, different styles become popular. But if we look at the two most popular style, there is one set of investor who look at value. And when I say value, it means they want some kind of margin of safety. They want some kind of valuation attractiveness, which you and Dhaval discussed in 2019 because of over ownership. Maybe that was missing. That is one style. The second style is where I don't want to, differentiate between trading and investing, but people like to ride where there is momentum, whether there's a value or not, whether fundamentally attractiveness is on valuation is there or not. But if the stock is performing, if the indices is performing, they would like to do well. Now, these are the two ways to look at it, and it would depend on the individual investing style. And if we can talk in terms of banking, so maybe I would like to share some data point and some chart just to highlight on these two investing styles. Where are we? So let me just quickly share my screen.
Yes, it has come up. Yes.
Okay, let me just go in Zoom mode and let me zoom it a little bit for everybody's benefit. So what I have done is this data is only for private banks. So I think in banks, we have public bank and private banks. For reference perspective, I have taken only the private bank data. And this number, which you see, this number is basically what I have done is I have taken the mean book value, price to book value of the private bank indices. And then from that, every year, every month, I have tried to see how private banks were trading with respect to discount to their mean book value. And if this value is positive, that means there is a discount in terms of valuation and If it is negative, then it means it is overvalued. And we can clearly see the phases of euphoria, like 2007 was a phase of euphoria. And then in 2009, it became very attractive. 12 to 14 year was a period when everything was attractive, including banks. We spoke about the two, you started the first question, you started with 2019 and we discussed over ownership. And that is reflected here in this data where you can see it was almost minus 25%. So that means it highlighted the euphoria. Then COVID gave opportunity. And if you see the last opportunity in terms of attractiveness, which came in 2022. So this is one way, which is purely fundamental, somebody looking at the value. But if I change my lens and investing style, and let's say I don't care about value, I care only about momentum, then the investing style becomes looking for momentum without bothering about value. The same 20-year period, if we analyze and how we define momentum, I think it's a concept. Everybody can define momentum in own way. Here, simply I am defining momentum because most of us, we try to benchmark performance with respect to Nifty. So if we benchmark the relative strength of private bank index with respect to Nifty, and we see the stock is in uptrend, for a momentum kind of investor, this could be the way to look at it. So all your Bs, which is this area, this area, this area, all this becomes a play on momentum. Now, this is based on investing style, but from keeping the investing style aside, what to look in terms of triggers. So for a momentum investor, it's all price volume action, it's relative strength, that is matters. But if we talk fundamentally, what to look, I think the most important thing is growth, because in the long run, everything works on growth. Also, banking is a very cyclic industry. You have your NPA cycles, you have your credit cycles. So tracking of the both credit cycle and in the NPA cycle where we are, and that is what has happened in the private versus public banks, where public banks, cleaned up their NPAs. That is important. And the third is the valuation, because when we look things fundamentally, valuation is most important. And you looked in 2019, how the most talked about popular banks, how costly they were. And that could be one of the reasons why we have not seen that kind of performance in the last 4 or 5 years.
Okay, great. Thank you for that. I think that table that you showed clearly highlighted how data has changed, and there are opportunities which keep coming, and then you have to utilize those opportunities as and when they come, as you highlighted. So Dhaval, coming to you on the current setup, right? Saurabh pointed out a number of factors that are important. For example, he said that you need to have a margin of safety, right? When you make bets on banking. The question to you is that when I broadly look at the data today, nothing is amiss, right? NPA cycle is favorable. There are no significant indications that we are probably going to see a bad or worsening of quality of credit in the near future. At least I can't see it right now. Maybe it can happen. But the signs are not present. Monetary policy more or less is stable. We are not seeing any major upheavals here or there, right? Margin of safety, I don't know. I want you to comment how are we placed there. But broadly, what are the 2-3 key points that you have in mind when you look at lenders, particularly today, and how do they make you feel in terms of investing in this space?
Sure. So if I just use my framework to sort of broadly encapsulate the question that you've asked. So if you look at growth, credit growth, for example, we are at a 10-year plus high, and even the 3-year CAGRs are better than where they were in 2012. So and it's on an upward trajectory right as we speak. So that's on the credit cycle. As far as on the NPA cycle, we are probably at all-time lows. 2008, 9, 10 was basically the all-time low period. We are almost at that point. And so in terms of credit cycle, we are at a very good point. In terms of ownership, I've already talked about. We have gone from one extreme to probably somewhere in the middle to the other side of the conversation of ownership. So that is as far as the ownership part is concerned. The last bit, which is on valuations. So I think generally, if I look at a sector level, things are very reasonable. Not out of whack. Both subsectors, be it PSU banks, be it private banks. I think generally reasonable. Stock specific, yes, there are some pockets which do look overowned or euphoria getting built in, but at an aggregate, things are quite well placed. So, and last one, which is very important, is return on equity. And we are at close to all-time high, if not all-time high, as we get the 24 numbers, where ROEs are, at close to all-time high, if not all-time. So that's where we are. So very well placed going into the subsequent 12, 24 months. I think the only variable here, which to my mind is at a risk, is profitability. The last point which I mentioned, return on equity. That's the only point which I am worried in terms of margins of banks, and some bit of compression is likely over the next 12, 24 months. Apart from that, by and large, I don't think we are worried. At least I'm not worried on credit growth. I'm not worried on NPA cycle and the other metrics that I talked about.
Sure.
So
I would want to harp on that point. Yeah, sorry, go ahead.
Sorry, just to sort of summarize the point of risk reward, I would say we have a very attractive reward with reasonable or relatively minimal risk. So yeah, that's where we are.
So, just harping on that point on NIM contraction. So, for example, if you were to look at the percentile where we stand today, I understand that last year NIMs are at close to lifetime high, right? And since then we've fallen largely because our deposit cycle has been slower than credit growth. Wholesale rates have gone up after RBI raised rates. But on the whole, are the NIMs falling enough? Because what I gather is that NIMs are still maybe higher than the past cycles, or at least their long-term averages. So how much should we be worried about NIM contraction from a longer-term cycle point of view?
Sure. So you're right that versus expectation, the NIM contraction so far has been better, and part of the reason is delay in the external benchmark rates getting cut, especially the repo rate, and that has had its impact on expectation versus actuals on margins. I just want to put this nuance that this is the first cycle where the banks are getting with more than 50% of their book external benchmark linked, and we saw the magic of that in the 22-23 period, where in a very short period of time the Reserve Bank increased rates by 250 basis point, and margins went in a very short period of time to all-time high levels. If some of that were to reverse, and it's a very big debate when it starts and how shallow or deeper the cut cycle is, but that's the flip side, and we'll, for the first time in the history of Indian banking, we'll see that play out. So that is where the worry is that if the cut cycle were to deepen, the risk to margins in a very short period of time, just because of the asset liability mismatch, can be material on the other side as well.
Okay, understood. So Dhaval, just one follow-up question. Assuming, let's say, RBI cuts rates by whatever X number, 50 bips, 100 bips, what is a material cut? For example, you will say that if RBI cuts by 100 bips, I'm going to be worried. If it cuts by 50, nothing major to think about. Is there? Can we think in those terms, or is it too stock specific or company specific to think about?
Yeah, at a broader level, I would say 50 bips is baked into assumptions. So it should not surprise a market negatively. But if we were to see 75 to 100 bips cut and possibility or potential of more cuts debated, then there could be pressure on earnings. So yeah, I would say 50 bips should be okay. 100 bips should be worried.
Sure. Understood. So Saurabh, coming to you, from a tactical standpoint, when you look at journey of last 5 years, also you looked at longer term data. How does this sector look to you? What are the key insights that you are gathering from the overall complexion of the sector? Plus, also, if you have comments on what Dhaval mentioned in terms of two things: margin of safety, particularly, and secondly, correlation with the rate cycle. Are you looking at that as a trigger, or are you looking at some other factors more closely?
Sure. So I broadly agree with Dhaval. I will add to few more points. So I think in terms of growth rate, in terms of NPAs, basically on the asset side, everything looks good. No challenges. I think factors which have not worked in last 4 5 years and currently some of the things which might become a challenge. I'll put a little bit of focus on that. So I think one thing which has been there, the FII based institutional selling, and I'm taking data of, I don't have exact data of how much of FI is sold in banking, but when I look at the data of top private banks like, let us pick a ICICI or a Kotak or a HDFC, and we see some amount of selling has come. And in HDFC, I am taking data. If we take the data post the merger of HDFC, the FI stake is down from 52% to 48%. If we look at Kotak, it is down from 39% to 37.6% in last 5 6 quarters. If I take ICICI, which has been the best performer, it is almost flat. I think in big banks, Axis is the only bank where FIA stake has increased. The point I want to make is many times we only think of fundamental, but banking, given it's a very high float industry, the promoter holdings are very less. When so much of supply is coming, and there could be various reasons why FIAs might be selling. They have made money in banking. I mean, they have made money for almost last 25 years. So that supply itself is a issue, and if that supply continues, God knows how market will react to it. That is one part. Fundamentally, the asset side, I don't see any issue. I think asset side, everything is going well. On the liability side, with the challenges of deposit which has come, and again, I don't know if it is a short-term challenge or there is something structurally happening. But the liability side, the CASA and all, that seems to be little bit of issue and worry. And actually, Q4 results have started coming. I have not analyzed the results in detail, but whatever 6 7 bank results are out, I see one trend coming is, the margins, the PAT growth rate has been much lesser. And the reason could be, as Dhaval highlighted, that last year we were almost at the best of the spreads. So I'm not sure if the spread is falling because of the issues on ability to raise CASA, but the PAT growth rate looks relatively lower to the to the NIM growth rate. So, and also HDFC merger has created its own set of challenges in terms of CASA. Now, different theories are coming whether this CASA will never come back. The bearish people, they're telling that this is a structural change in terms of CASA and banks are going to lose CASA, and hence the benefit they had, that benefit they will not have in future. I think those things are debated, but that is something which we really need to monitor and track how it progresses, and then accordingly, the future results could come out.
Sure. I surely want to get onto two of the hottest topics, but I'll get on them. But Saurabh pointed out this CASA issue. These deposit growth, and for a very long period of time, a lot of people, including me, have been talking about that. Credits will create their own deposits, right? That cycle will happen on its own. Is it too slow, or is that loop broken right now? Any viewpoints on that?
No. I think you're spot on. I think credit creates its own deposit with a lag, and right now the way credit growth has been in the last 2.5 years, it's on a tear. No one expected these numbers at the start of 2021. So it's just deposit is taking time to catch up. In addition to that, I would make one more point: the regulatory environment that has changed post October, where from a neutral liquidity zone we went into reasonable deficit for subsequent months, with CRRs also being 50 bips higher than where they were pre-COVID. So combination of regulatory stance plus the momentum on credit, it has had an impact on the deposit growth, and which is why we've seen that deposit rates have gone up. They took some time, before the repo cut. I mean, once the repo cut happened, they did not go up immediately. There was still some lag. And if you look at right now, incremental deposit cost on the term deposit side, actually banks have passed on 250 bips on incremental basis. It's on the loans where the transmission has been lower and close to 150, 160 bips. And that's the reason, the point that we were making on margins, that becomes more powerful here. So I would say deposit growth is likely to come back, and banks are making rates more attractive, real rates more attractive to garner more deposits. So we should see the incremental numbers be around 100, which they have been in the last few months, and start to come down, supported by the regulatory intervention.
Sure. Dhaval, you mentioned the regulatory intervention from liquidity standpoint, but we've also seen up the industry. We had 2-3 episodes where RBI highlighted certain parameters in a bank in one NBFC. So, for example, the most recent episode was with Kotak Bank. How deep are these instances? How seriously you take them from when you take a 5-year view or a 10-year view? And also, I want to marry this question with one data point which Saurabh mentioned, which is FI selling, or let's say broadly where investors have been not so upbeat on banking per se, maybe because of these intermittent interventions and news articles which are coming about. So do these things worry you, and what do you do about them when they happen? How to tackle them?
Yeah, very important question. In my 15 odd years of looking at banking sector, I would say that there are these moments which come. I mean, they would have happened thrice in this period, where the regulator changes its normal course of action and redefines the journey. And in October, November of 23, we had one such instance where the regulator, on issues which were pre that moment, were considered business as usual, and the regulator would engage with the respective regulated entity, and at the end probably levy a penalty, or small penalty, or take small appropriate action. That is how the norm was pre October 23. Post this period, we have seen significant change in stance from the regulator, where customer complaints, areas of customer complaints, areas of governance have become quite paramount, and the consequences are no more insignificant or less material. They are quite dramatic, I would say. So there is a signal, or there is a message that the regulator is sending, and I think most companies that I speak to now, they are now cognizant of this new era of RBI, and therefore their response to any such gaps, or areas of improvement which the regulator calls out, are multifold more serious than what it was probably pre September 23. I'll give similar reference was in asset quality review back in 2015-16, when the regulator changed its norm of going from multiple forms of restructuring to one-time cleanup activity, and then it was followed by one more round in 2017-18. So these are points. Once in few years we see RBI up its regulatory actions, and therefore the environment gets readjusted to these new realities. So I would say yes, it is quite material. It came as a surprise to me as well when it first happened. Subsequently, the point that you mentioned, how are we dealing about it? Just reading through what the regulator is now emphasizing, and figuring out ways and means to see where these gaps are in each of these companies, portfolio companies, potential investee companies, and trying to get more detail around that is a very rigorous exercise that we've started doing in the last few months. So that is how we are trying to take action. And I can give more insights around this if there are follow-ups, but broadly that's how we are approaching it.
Sure. So Saurabh, you run a structural portfolio. You also look at more tactical ideas. Uh, Historically, we've seen that when regulatory action happens, if valuations are very high, usually it takes a very long time for the industry to recover. But more often than not, these regulations eventually help the sector. It infuses confidence, corrects some of the excesses or possibly the some of the broken areas in the system. At this point in time, how do you look at whenever these events take place? From a because many of these companies are index companies, large cap companies. A lot of investors own them. Very high volumes, trading volumes as well. How do you tackle these interventions and events, or do you look them as opportunities? If your structural view on the sector is right.
Yeah, so see, these things, they do take time. Like if we take example of HDFC, like we just spoke about what is happening with Kotak, and what is happening with Kotak, HDFC went through it almost, I think, more than 2 years back. And then if you look at the management commentary, I think there is a lot of focus on, improving it and the technology spending. In fact, most of the banks, I think 8 to 9% of their operational expenses are happening in technology side. The biggest hiring, if you see in their vertical, the technology division, they're doing it. But these kind of things, regulatory fixes, these are more a journey which will take time. And good price and good value, they don't come together. So I think ITC, which was a meme stock, nowadays HDFC has become that stock. But the only thing is, good prices and good value don't come together. And let me show you, not only with regulation, but anything which has an impact on the stock price in the short term, and how value emerges and how that value again converts into good return. Let me again share my screen and show it through the industries. Again, last 20 years of some of the sectoral cycles, how some of these things have played out. And let me just quickly share my screen. Let me know if you can see my screen again.
Yes, it's visible for.
So what I have done is I've just picked not many industries, but I have picked just 4 or 5 industries. And knowingly, I have picked some of the industries which have been the best wealth creator, so that I can show even the best of the sectors can go through the bad phase. How this data is arranged is I have picked the starting periods of every year right from 2004. And again, I have benchmarked these sectors with Nifty performance. So this is what the return of Nifty was in that particular year. And this tells whether this particular sector has given a better return or worse return than Nifty. More positive means better return, negative means bad return. Now, what I have tried to do is I have picked the best and worst performing sector, and there's a clear pattern here. And the patterns I have tried to color code it. So you can see in 1 year, for these 2 years, FMCG was the worst sector, and next year FMCG becomes the best sector, and again it becomes the worst sector. In 2006, IT, auto, FMCG were the worst sector, 6 and 7, and this is relative. On absolute basis, they might give positive return. I'm trying to do it on a relative basis among sectors with respect to Nifty. 2 years, IT and auto were worst sector. Third year, they become the best sector. If I take an IT, 2011, IT was the worst sector. 12, it becomes the best sector. After 12, again 15, 16, 2 years continuously, IT was the worst sector. 17, IT becomes the best sector. Then again, IT is off. And then we have IT as best sector for 1920, almost 75% outperformance. And look, it becomes the worst sector with almost a 30% underperformance. Auto, which was the worst sector continuously for 2 years. And remember, auto cycle peaked somewhere in 2018, and we had a very good auto run. That is why 15, it was one of the best sector. And then it became the worst sector of 18-19 and didn't figure out for 2-3 years. And then it came out with a banger. And last 2 year, auto has been one of the best sector. The message I want to give, whether it is related to regulation, whether it is related to overvaluation, whether it is related to business cycle or whatever, basically among the sectors, the cycles keep changing, and things which have not performed, where slowly the value starts emerging, which I try to show again from a book value kind of valuation. Those are the things which perform. And most of the times when things are not performing, obituaries will be written. Like for IT, I remember in 2016, people were telling that machine learning is going to replace all the engineers. And now similar kind of things you might be hearing about generative AI. But the fact is you had a 14% growth rate in IT sector at an overall IT level, which was like the second highest growth rate in 25 years. And now you have the generative AI thing, which is everybody's feeling going to kill. So this good news, bad news, overvaluation, undervaluation, this is cycle, it keeps on rotating. But in terms of framework, that is where we have to look at opportunities. And most of the times, for somebody who is looking for a margin of opportunity, margin of safety, these opportunities will come in those sectors which have not been the best performing for last 2-3 years, and then slowly the value emerges. So that is how I look at it, irrespective of whether it is coming because of regulatory issues or any other issues.
So that is useful, Saurabh. I think one thing I pick up from your idea, what you said, is that good news and good prices don't come together. But of course, good prices and bad news does come together. We've seen that again and again. And that question is for you, Dhaval, on the largest weight in whatever index we pick up, HDFC Bank. It's there everywhere, right? In most portfolios, in most indices. Also one of the market darlings for some time. But over the last 1 year, we've seen that the stock price hasn't really done as much as what people would have thought that it will do. What is the outlook? Because it itself is one of the largest part of the market, right? You can't talk about banking without talking about HDFC Bank and of course maybe SBI. But what is the outlook on HDFC? What do you think is the runway when you look at from where it stands today, and where does it stand in terms of its own valuation versus its own history?
Yeah, so the last one is easy. It's probably at all-time lows. Barring some black swan event like GFC. I mean, it's at all-time low in terms of valuation. To the point of what has sort of led to this massive underperformance over the last few years. I would say that part of the reason that I alluded to earlier were around over ownership, and HDFC Bank was never part of the MSCI until the merger for a very long period of time, and it was owned by foreign investors, so they were running massive overweights on HDFC Bank, and that coupled with the turnaround that we saw in some of the other beaten down names, be it some select private banks or state-owned banks. We saw turnaround of that take place, and suddenly capital started to incremental capital first, and then over a period of time the base money also started to move within portfolios from HDFC Bank to other names, and similar story has been there in some of the other names as well. So that's the second part. The third is once we were seeing some bit of recovery in their own performance back in 21 end and 22, we were hit by this news of merger. And so I always tell at the time of NFO also, I used to tell that it is one of the very good banks in terms of both performance and wealth creation. And HDFC Limited has been a massive wealth creator and a very good mortgage company. So two good businesses, but merged at a wrong price. And that's the problem that we all are facing in terms of mismatch of what the synergies were and the price that we paid for those synergies. So I think so that's where we are. It's been massive underperformer. Is there a margin of safety? I would say yes, there is a margin of safety. Is there enough pessimism in terms of ownership and in terms of earnings expectation? I would say we are gradually getting there. So combination of that plus some positive catalyst in the space can lead to the poor core performance coming back. So I would broadly say that if someone were to just look at the market capitalization and look at where it is right now versus where it was when the merger was not there, he will have a fair idea of what margin of safety is there and how much potential is there on the other side. So yeah.
Absolutely, I think that is a very nice lens to look at in terms of the overall market cap and getting a right assessment of how much margin of safety is there. Saurabh, the market lens for banks is twofold. A lot of people think about banks in terms of PSU banks and private banks. Largely, I think when I think about banks, I think about banks as banks, not about anything else. Then you qualify and filter it later. But there is a lens of looking at private banks and PSU banks, and we've seen PSU banks have been flying. They have done very well. The PSU bank index has beaten the private bank index hands down by a very wide margin. And as you pointed out, the relative performance, how it changes over time. Do you think there is merit in looking at private banks more closely, or do you think the momentum factor, which you spoke about earlier, still favors the PSU basket as a whole, or there is more legs to the other part of the market? Are there any enough signs that you're gathering to look at these two aspects?
My view is, if we look right now, which are the sectors which are doing well, and we all keep tracking the quarterly data. Anything related to exports, I think, except auto ancillaries, most of the things are not doing well. Pharma has started doing well, but the better performance is coming from domestic economy, and better performance is coming from sectors. Earlier, 5 years back, it was all about asset light, and now it's all about manufacturing and asset heavy and infrastructure, real estate. And when we look at sectors like infrastructure and all, I think mostly the lending comes from the PSU banking side. So I think when you are, of course, retail banking is doing well, and that is common for both private and public. But when it comes to sectors like infra and all, and infra real estate, they have come in. If you look at this kind of performance, it is coming almost after a decade. And I don't have idea that whether it will perform for next 1 year or next 2 year, next 3 year, because I think most of the times when we make these predictions, we go wrong. So what I believe in, let it perform till it is performing. As of now, we know PSU banks are performing. The sectors where they lend to, they are performing. There's growth opportunity, order book. I mean, whatever data you track, everything is performing. So the first trigger, if I have to worry, the trigger will come when you will see at least a quarter over quarter peaking out of the numbers. And most of the times, either it's too much of overvaluation, and because of that, you will see the momentum peaking out, or the fundamental result, you will see that it keeps on performing, and then a quarter over quarter expectation of performance versus valuation, it will peak out. But till that time, it is not happening. I mean, I would refrain from taking a view that this will perform better or that will perform better. In terms of value, also, I think value is also cyclic. So the same set of PSU banks, when they have huge amount of NPA, a 0.7 book value also looks costly. When the NPAs are cleaned, a 1.5 book value also looks cheap. So the way I will look at it is, in terms, I will take PSU bank basket more as a cyclic basket, and I will wait for the cycle to top out and some indication to come, either in terms of NPAs or in terms of too aggressive lending, something which gives me indication, or even in terms of price momentum. But coming to private banks, I believe, as Dhaval said, I also believe there is a clear case of value emerging here. It may not be, in my view, it may not be very attractive. Even if we look at some of those historical book value comparison, I think we are somewhere in the fair zone. But because HDFC is one big weighted stock, which is bringing it down, but ICICI has been doing well. The price is also doing well, and the valuation is also around the fair range. So I think for somebody who is of value mindset, private banks do provide an opportunity. But somebody who wants to play momentum cycle without getting into whether PSU has become structurally a good sector industry to invest, I will not get into that. But till the results are good, till the NPAs are clean, till the prices are performing and valuation is not very, very frothy, it's okay to write both of them. So that is how I look at it.
Sure. I will probably try and put both of you in a spot and ask for your views. And I will also have some questions which I've received from the audience. I'll ask you, both of you, those questions. But first is, I want to talk about the structure to participate in banks, right? So there are various ways and means. You have a bank Nifty index, you have an ETF, you have number of strategies or thematic category in banking. When you look at the overall complexion, right, banks are one of the only sectors probably trading below their long-term average valuations, while the market trades at 1 standard deviation or 2 standard deviation higher than its long-term average, whichever way you slice and dice. What do you think is the most apt participation that you think is right today? Do you want to participate via stock picking, bottoms up stock picking of a few lenders, and I'm only talking about banks and NBFCs probably, right? Or you would want to take an index approach and look at, let's say, buying the full bank nifty or maybe even a broader index. What are your thoughts? Maybe Saurabh, starting with you.
For me, it all depends on what I want to achieve with that stock and what is my expectation from that stock or from that index. So first question, index versus stocks. I think if I have a complete clarity on a stock, if there is a margin of safety where the stock is differentiated, I might go stock way. But if all the companies look very, very close and I'm not able to differentiate which will perform better in the long run, I may go index way. And you rightly said, I think this is a market where for value wires, it's little bit of challenge because there are always times when you say this sector is totally undervalued. This sector, there is a lot of value. But if you forget chemical, which has not performed for last 2 years, and bank, which has not performed at par as per expected, I don't know which sector to look from value perspective. So that way you are right. And in banking, more on the private sector bank because PSU still, they have performed. So that way, yeah, it does offer at least a fair value kind of opportunity to me. Now, how I'll put my money. So I see there are certain companies in banks where it's my personal view. Like if we take a ICICI versus a HDFC versus a Axis, I would like to look at things where performance is also there, momentum is also there, and valuation is also not frothy. Somehow I feel Axis is best placed there because still you have 48. I think their cost to income is around 48%. HDFCs and ICICI is around 40%. So they have a scope to improvement. Whether they will improve it or not, I don't know. But there is a scope to improve. And if they are able to improve it, maybe some bit of more re-rating can happen. So if I have to look at a stock way, I need that kind of differentiated opportunity which exists. And if it is there, I would like to go for it. But if I pick a HDFC Bank, I will not have any expectation for next 1 year because the stock is not in momentum. There are no positive triggers and I will have to wait. So it's a question of one expectation and two different stocks can have different expectation. But if I don't have time to get into all the details, track all of that, maybe I will buy an index. But if I'm bullish equally on all these stocks, or I don't have time, or I don't have ability, because banking is also, I mean, these are still big banks, proven banks, still it is okay. But when we get into NBFCs, because you talked about NBFCs also, there are a lot of surprises which happens. 2017 Edelweiss was a big surprise. Piramal was a big surprise. So these kind of surprise keep coming, and the best of the minds also, sometimes they are not able to track. So things which are very risky, maybe I will go more at an index and ETF level, but things which are less risky where, there is much more better visibility and ability to, gaze it, I will go more at a stock level. So if I have to make a basket of NBFC, maybe I will go at an index level. But if I have to track, let's say bank, and I have these companies available, I will have a different aspiration and different expectation from HDFC versus Axis. That is how I would like to play.
Sure. I think some very beautiful points, sort of, that you highlighted, specifically the risk point. And so, Dhaval, let me rephrase my question for you. Because I think maybe I can gauge some response that will come from you in terms of bottoms up stock picking. But is it harder for a manager to pick alpha giving stocks when there is an outright bull market versus when the sector is struggling and you have so much news coming in? Is it fair to say that this is the time where you can figure out that over a period of time, where does the value reside and where is the possibility that a company can do better? So maybe the question is this the right time where you can generate alpha because there is so much happening?
Yeah, I agree. I mean, this is the time where relatively, I mean, alpha generation is in absolute terms is difficult, but relatively, this is that time where it's easier to generate excess return. And given what we've discussed in terms of nuances of each of the investment opportunity, I think it's relatively easy right now to sort of get alpha. So I agree. I mean, I think active management is a better way. Bottoms up, as my framework and my thought process is a better way of capturing this upcycle.
So let me also sneak in an alternative view that when you look at a bank index, Nifty Bank Index, you have 2 or 3 very large stocks which are also a very high weight. And when you look at these top 2, 3 names, you also see that they are maybe close to their fair value, or some of them are at discount also. So maybe that also becomes a very good strategy for somebody who doesn't want to take that call. Maybe from a risk
Correct.
perspective, it's sort of pinpointed, or from the ability to pick that particular stock. So I think it's a varied approach, and because all these instruments are available, I think investors are having a good time picking up what do they want in terms of the structure that they like. I have a few questions which have come in from listeners. First is, Dhaval, to you. You pointed out that if rates fall, there is a possibility that there could be NIM contraction. The question is, can NBFCs benefit more or perform better in a rate cut cycle from where we stand today versus banks?
Yeah. So what we saw for banks between 22 and 23, where margins expanded in this period of similar period plus 24, if you were to add, we've seen contraction or by and large pressures on margin for NBFCs and even some wholesale funded private banks, and so basically that's the basket which on the other side, when the cycle turns, can see some relief in terms of profitability, at least on the margin side. So I do agree that in a environment where rates were to go down, or at least the signals are there, NBFC should perform better.
Sure. Second question, Saurabh, overall to you, when you look at the fight for deposits, there is we've discussed it in some aspect, but there is a fight going on for deposit because banks want to raise as much CASA as possible. Do you think that in such a framework, credit growth will continue at the pace that it is currently going on, 15-16% when you look at the disaggregated numbers? Is this number sustainable? And also, let me put in my question also, which is also similar, that if you have maybe 10%, 10.5% nominal GDP growth rate, can you sustain 16%, 15% credit growth? What are your views?
So I think these things are very much interlinked with a lot of other factors, and it doesn't work so easy. In fact, one of the con call I get reminded, I think this question was asked, and one of the banking veterans, they replied that, these things go out of, they mismatch on a 6-month, 1-year basis. But once you go on a 3-4 year basis, ultimately your credit and deposit growth rate, they need to go hand in hand. That is how a banking works. Now the question is here, how it will happen and all. So again, there are different reasons being given why CASA is falling. Some people are telling because the market is giving such a good return, nobody wants to put their money, so everybody is taking their deposit out. Corporates have become more intelligent. I don't know. This is the first time I'm seeing AMFI giving ads in IPL for debt mutual fund. So far, we have seen only equity mutual fund. So I think these things will play out, but in the longer run, there is if we look historically, there is a relationship between the nominal GDP and the banking credit growth rate, which goes around 1.5 times to 2 times. That is there. So if we are really saying that India has to grow at this kind of rate, the banking has to perform, the lending has to perform, and lending cannot happen. You cannot grow your asset side without your liability side. So that has to go hand in hand. We always think that this time it's different, but structurally, that is how your banking model is. So how will you change your model? The only thing which can happen is, your CASA may go down. Your NIMs might come little bit in pressure. I think that is where in valuation, whenever we pay for a company, we need to build our margin of safety so that we don't get surprised by these shocks. My personal sense is maybe historically the kind of CASA banks have enjoyed in future, they may not enjoy that kind of, But even this is a cycle, this will turn up and again people will go, a cycle will come and again people will feel that, okay, putting money in the banks is, better. Those kind of things will happen. But yeah, getting that 4% kind of, deposits like they have got earlier, I believe maybe in future that may not be equally possible. So there could be some structural changes, but still I think we need to factor that is how we need to factor in the valuation, and we need to take our buy decisions.
Sure. So we are getting very close to the end of our call. So I have gathered 2-3 points, and I'll maybe ask the last question to both of you. So I've heard that there is some margin of safety. We are close to fair value, or in pockets some more value has emerged. Second, we are seeing that there is no real asset quality stress that we are witnessing for now. There are no signs as such today which are strong enough, which means that cycle could fairly be longer from where we are standing today. Third, there is also under ownership, maybe if I picked up correctly, in some of the stocks, some of the large stocks where we've seen large selling from institutions specifically. So there are certain attributes, and of course, as a pack, it trades at below long-term average valuation when you look at all the lenders put together. So my question is, let's say Nifty or the large cap basket, more than a third goes to banks and NBFCs. Is this the right time to have higher exposure, which means being overweight this sector, or is this the time to be underweight? So Dhaval, same question to you, and then Saurabh also to you. Dhaval, if you can answer this question.
Yeah, so like I said, quite constructive. We should be overweight BFSI as a pack, and there is opportunity at a broad level in banks as well as in NBFC. So very constructive, very good time to look at this space for making some extra return.
Sure. Saurabh, what about you?
The way I look at it is, I think it is fair. And again, if we look at the data, if we pick October month, the attractiveness was like 25%. Right now, if we see, we are 9-10% around, more than the historic mean. So maybe either a SIP approach over 1 year, if it doesn't perform and your EPS is growing, it's growing at 10%, 15%, whatever. Again, we become attractive by 20%. Or if there is a 10% correction, then again it becomes those attractive. So I would consider it as fair. But if we don't perform again for next 6-8 months, while earnings are good, or there is a 5-10% price dip, then it becomes really attractive to go and where we say that, okay, let's do a lump sum. That is how I take it.
Sure. And to both of you, more, let's say, a call on where the market is today. Do you think that this sector is a good relative performer for now, or there is also a possibility that it can deliver absolute returns going ahead? So, because relatively, I understand that it can perform well. So, Dhaval, what do you think?
Yeah, I think absolute returns are possible in my view with fairly attractive risk reward, and so relatively yes, absolute 100%, very high chance.
Sure. So Sahil, I will talk from my personal portfolio perspective. I am more a small cap investor. And I think whatever data points we look, we know that, okay, small cap is performing well. But in terms of value, I mean, there is no debate if we look at the valuation versus the earnings which are coming. So I am taking banks both as a hiding place in terms of, if not small cap, then where, and especially large cap banks. And also given the valuations are not frothy, it's attractive, and the expectation to perform well is there. ICICI is performing, Axis is performing. Of course, HDFC has challenges, but again, as I said, my expectation is nothing for next 1 year. So when I allocate, let's say, a 20% of my portfolio in this, one way I see, I am trying to safeguard myself from a volatility which might come in small cap. At the same time, with a given last 2 years have been great, a 10, 15, 20% maximum kind of return if we are expecting, maybe at 15%, this is the place to look at.
Sure. Thank you. So I think when we look at from a broader lens, when you want to, a lot of people want to participate in whether India can deliver or not. This is one sector which is possibly close to fair valuation versus a market which is slightly more expensive. Also shows you much better financials. There are some risks which Dhaval highlighted, Saurabh highlighted in terms of possible NIM contraction, where the interest rate cycle is. That could be a spoiler. But overall, I think there are a number of points. Under ownership, bad news regulatory changes, sector not getting enough flows, or the investor love. It all are ingredients where it can perform much better in the future. And there are a number of instruments that you can participate in, right from passive funds, active funds, direct investing in stocks. So I think, and this is one sector which contributes so much to profitability. BFSI as a whole contributes almost 40 out of 100 rupees to profitability. So you can love it, hate it, but you can't ignore this sector at all because of the size of this sector. So possibly take a deeper look, and we are going to come back with a number of new sectors and ideas on adding zeros in the next future episodes. Thank you, Saurabh. Thank you, Dhaval, for finding out time, and thank you for all your responses. For all of you, we'll end here. Thank you for joining and signing off today. Thanks.
Thanks, Sahil. Thanks, Dhaval.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.